Rahul Malani joins us. Rahul, good morning. Thank you for joining us. Uh, we are looking at numbers in the morning. There's no wow, but do you think now one can safely assume that the scope for any more negative surprise from HDFC Bank is unlikely?
So first of all, good morning. You already did right it that the probability from here on is unlikely that any additional bearing factors could come, which could weigh down the earnings trajectory of the merged entity. In terms of NIMs trajectory, also we expect NIMs have been under pressure and came in higher than expected at a lower rate. But we believe that at this point juncture, NIMs have probably bottomed out and it will improve gradually. But important thing is here is that the key challenge remains at this point of the cycle is that the higher credit deposit ratio, which is at 107% higher than the industry. And currently, we believe that the loan growth is expected to be in low mid-teens in near term, which should normalize that CD ratio gradually. So basically, currently the challenge is that the choice is to slow down the growth and focus on improving the liability profile, or to have a gradual improvement but deliver the higher than industry average loan growth. So the, the key is to decide whatever path is to be taken. And currently, we do not have a differentiating factors which earlier we used to have in HDFC Bank, like higher unsecured portion, which and a lower credit cost compared to the peers, like to the likes of the ICICI and Axis, and a temporary weak liability profile also remains a key challenge at this point of time. But over the period, at least over the 12 to 15 months, we should see improvement in all the key metrics, which should result in certainly re-rating of the stock. But we believe that in the next 12 months it will likely to consolidate.
So, Rahul, when will HDFC Bank, I mean, purely looking at what is happening in the financial sector, when do you think it becomes from a buy to an attractive buy? It was always a buy, but when does it become like a value buy?
See, currently the valuations are very handy. If you look at the things in a current juncture, when the things will turn, valuations are currently reasonable at this point of time. Whatever the circumstances happens, and we at present we believe that the decadal loan growth, which were growing at 17 to 18%, would certainly grow at 14 to 15% in next decade. And so valuations have already priced in. So we believe that a gradual build-up in the position should be happened with a long-term view, and we do not see any outperformance in the near term, but we will see outperformance once all the key metrics comes in place, and because key metrics has to be compared in line with all the competitors. So we right now it does not have any differentiation in terms of key metrics, which is allowing a re-rating in the stock.
And since we have you with us, talk to us about the latest commentary coming in from Jio Financial Services as well, if you have tracked that one, because they're talking about how they are getting into secured lending, salaried employees, self-employed people. D2C kind of model is what they are employing. What is your read-through for the entire financial services sector?
See, I cannot comment on the stocks, on the Jio Financial stock, as we do not have a coverage and we have a compliance section on that.
No worries. Thanks so much, Rahul, for joining us today this morning with that quick take as far as HDFC Bank is concerned.